We are now moving into another administration, and this is something that we talk about all the time, is that every administration has a different idea of what they want to do with taxes, with the economy, with the Fed, with interest rates. This is all going to affect our money. So President Trump is back. And so one of the things that you and I talked about not that long ago was the Trump Tax Cuts and Job Act that was scheduled to go away at the end of next year. Right. Are you looking that he would probably renew that and we move on, or do you think they'll make adjustments to it? What do you say about that one?
Yeah, a bit more clarity now than we had, a month or so ago, right? On where everything is heading. We were preparing for the fact that if he didn't win, that Jobs and Tax Cut Act that he passed in 2017, I think it was, would expire next year. It sure seems likely that it's going to either, one, get extended or extended and revamped in some way as well. It's a bit too early to start making decisions on it because there's been a lot of things promised. I mean, not from Trump. But both sides promise a lot during the campaign. It'll be interesting to see what actually gets implemented, though.
Well, one of the things that would certainly affect retirees and people getting ready for retirement is his campaign promise that he wants to get rid of federal taxes on Social Security. And that seems like a great thing, a great campaign promise. I can see why people love that. But then on the other hand, I saw some analysis of that, and people say that will empty out the trust fund sooner, and that would damage Social Security. So how do we absorb that one?
Yeah. That was a popular promise, right? It might have really helped get him elected there.
Yeah.
I have the same concerns about how practical it is as well, right? There's been a lot of talk about, so not taxing Social Security was one of the things. I think this has actually opened a lot of people's eyes because we have discussions with clients a lot, and they assume Social Security is not taxed. Anyway, and then it's a bit of a kind of a shock when we go through like, well, no, it is. It's just a matter of how much of it will be taxed, right? Depending on your other income. That's been promised. No tax on overtime was another one.
Right.
No tax on tips.
Yep.
It sounds great. And if there's a way they can do it, even better. I just don't know if the numbers are there.
Yeah.
For it to be the way that it's been described. Like I said, I don't know what else they've got in the works. So maybe there's something else to make up for it. I've talked about tariffs a lot. We can get into that a little bit later if you like. I hope it can happen. I think it would be a boost for the economy. I don't know how realistic it is numbers-wise.
Well, speaking of a boost for the economy, the last time Trump was elected, there was the Trump bump, and that lasted from November all the way to the mid part of March. And we are experiencing another bump right now. Don't know how long this one is going to last because there's the Fed and there's probably a few other things that are going into all of this. And Santa Claus rally, I don't know what we're going to do before the end of the year. But the idea that Wall Street kind of likes deregulation. They like lower taxes. They like the fact that his stance on capital gains is that he will move capital gains taxes down. So he is a Wall Street friendly guy. That kind of bodes well for those of us who have a bunch of money in a 401k and in the market, doesn't it?
Yeah, it does. And I mean, really what you're describing there, right, is they like an easier business environment. That's what it is, right? That's what you're discussing there, whether it's the regulatory side of it, whether it's capital gains, whatever it might be. They like an easier business environment. All of the fundamentals that would indicate a good economy, would indicate a continuing stock market, seem to be there. The only caution that, because look, what we discuss here, it's very similar to what we discuss with clients face to face, right? So it's not like these are new conversations that we're having. We're having them multiple times a day with clients. The stock market's come a long way in a pretty short period of time, right? Valuations, and when we say valuations, we say basically, what's this stock trading at compared to the earnings it's producing, right? That's an evaluation. They're pretty high. For historical numbers, they're pretty high, and what that means is that the stock price is high compared to the earnings or the profits of that company, right? That's the only thing that gives me pause. I think there's a lot of great fundamentals there behind the scenes. Those are just a couple of issues that are keeping us up at night a little bit.
Does this make you move money in different places? You would think that, with a Trump administration, I don't know that I'd be investing in China. I think I would be a little bit more toward made in America. I don't know that I'd be international with my portfolio. I don't know. Right. He seems to be very Bitcoin friendly, maybe, and Bitcoin has gone through the roof. So there's the alternative investment area. Does this have your client saying, hey, let's find out where he's friendly, where the Wall Street likes him, and let's push some money that direction?
Yeah, at a very high level, and again, when we're on this show, nothing that we say is a recommendation, obviously, because we've got to know about someone's individual situation, but at a high level, the discussion we've been having around is maybe we should start looking a little bit more domestic in our allocations, right? There seems to be a big push for made in America, manufactured in America. Relying less on imports from overseas, and there's going to be policy around promoting those sorts of ideas. And so what you tend to find is that those more domestically based companies tend to aggregate more in the mid and small cap sector of our economy, right? So, if it doesn't mean you pile all your money in there, you really shouldn't, right? You should always be diversifying, but do you maybe consider overweighting that a little bit? Maybe. You need to talk to somebody about it, but it's something to think about with the environment we're in.
I would think that, this would be a subject for a meeting. I know that you meet with your clients as needed. Certainly we want to, have a meeting with a client at least once a year to find out if anything's changed with you. Fourth quarter meetings are great, and that's where we are right now. And maybe that time is slipping away, but that doesn't mean that right after the first of the year, we can't say, hey, let's take a look at what the economy is, the environment is, the interest rates are, where we're going with all of this, and say, are there any moves to be made? I mean, when there's changes in your life, come on in. Let's talk about it. But if there's changes in the economy and the administration, that's a reason to come in too, isn't it?
Yeah, it really is. Is what we present our clients with when they've decided to work with us is we say, okay, great, we're excited to work with you. From now on, we want to be your first stop for anything that touches your life financially. Okay, it doesn't mean that we do it. We do it here at Secure Financial Management, right? We're not mortgage brokers. We're not realtors. But back when refinancing a couple of years ago was all the rage, and people were refinancing every 2 or 3 years because the rates had come down 1%, we'd say we're not mortgage brokers. We're not in that space at all. But come and talk to us about what your plans are so we can talk you through it. Make sure that you're making the right decision. So, a presidential change, a change in economic policy, which looks like it's going to be fairly dramatic, that's a reason for a discussion, absolutely.
Yeah. So one of the other things that's taking place right now, in the month of December, there will be another meeting of the Fed on the 18th. They are still chipping away at inflation, saying that, we're going to continue to lower rates now. And they're trying to get inflation down to 2%. It ticked up just a little bit at the last meeting. So one of the things that I've heard out there is people saying the economy doesn't need any more stimulus. Tell the Fed to stop. And I've heard that too. The Fed seems to be kind of in a tough situation. It's like, where do we find the happy place? Right. We got to find a happy place for people who are buying homes so they can afford their homes. So we got to have a lower interest rate there. We got to find a happy place for retirees and for people who don't like the risk of the market. So what's that? 3%? And then we've got to find a place for the Wall Street people that say, don't get that interest rate too high because we want people in equities. Is there a happy place for the Fed?
Yeah, all those things you mentioned are, I'm sure, things they're thinking about. This is the thing. This is, if you want to try and get in the mind of the Federal Reserve and Jerome Powell or whoever you kind of want to focus on there, they're supposed to only focus on two mandates, and the stock market's not one of them. Okay, now whether it really is behind the scenes or not, that's a discussion for another time. They're supposed to focus on maintaining employment, essentially, right? Stable labor markets and keeping people employed. And they're supposed to focus on keeping inflation under control. Those are the two things that they're supposed to focus on. Now, Do they get concerned about the property market and the housing crisis we've got? Probably, right? Do they get concerned with the stock market? They say they don't, but it's hard to imagine that's not something that you think about, right? But they're really supposed to focus on employment and inflation. I got to tell you, and I'm very open with this with clients too, like, I've been wrong about the direction and the amount of cuts that I think they should have done, right? I really didn't think they were going to do 50 to start with. I thought they were going to do 25, and they rolled out with 50. And I thought, all right, well, maybe they want to kind of get this rolling and they'll just sit back for a little while. Well, they followed up with another 25. December will be a very interesting meeting. Because a lot of people we speak with, a lot of our economists and stuff, we think it's too much too quickly. And we're hoping that they don't continue to push this. And it's not that we don't want a low interest rate environment. I mean, that's great for growth. That's great for borrowing. It's great for building, all those sorts of things. But then you risk inflation coming back. And this is what happened. I mean, you got to go way back, right? But this is what happened in the 80s. Is that they tried to get inflation under control. They're like, all right, great, we've killed the inflation dragon, we've won the war. And they celebrated too quickly, and what happened? It all came back again, right?
And then they had to raise rate, they got egg on their face.
Dramatically. And so I'm not saying that will happen this time. I'm sure hoping it doesn't. I'm rooting for the economy. I'm rooting for this country, believe me. That's one of the things that I'm concerned about, though, with them lowering too much too quickly. And I heard an analysis on this, and someone said, I think they kind of got scared back in, when was it? October they did or September, whenever they did the 50-point cut. I think they kind of, they got scared a little bit and like, all right, let's get moving on this. Maybe, but I mean, look, I know the unemployment rate's gone up a little bit, but what is it, low fours? That's still not high,
very low.
Right? But by any means, inflation has come back under control. But they keep saying they want to get to 2%, and we're not there yet. So and I'm not knocking them. I would not want to have that job right now. I can tell you that.